Sonya, thank you for joining us.
Thank you so much for having me. Good to be here.
Hello, everyone. Welcome to Collecting Compounders, the Cross-Border Wealth Edition. My name is Pedro Ribeiro. I'm a portfolio manager and cross-border wealth advisor with Marnoa Private Wealth at Raymond James. Joining me today is Sonya Dolguina. Now, did I pronounce that correctly?
Yeah, Sonya Dolguina.
Delguina. Sonya's a CPA at Raymond James and is located out in beautiful British Columbia, Vancouver. Is that correct?
Yes.
Perfect. So we're going to be covering a few topics today. We're going to be looking at what Canadians should consider before making a big move to the United States, some of the tax implications that may arise, and if you're going there on an E2 visa or to set up a company, even the legal structures that you may potentially want to avoid as well. And if we have time to cover those previous ones, and then in addition, some of the biggest trends and reasons why Canadians are actually moving to the United States. Now, we may not cover everything in detail, but we're definitely going to try to squeeze in as much as we can. So, Sonya, it is great to have you on the podcast today. I'm very excited I'm actually looking forward to this conversation, very excited about it. Before we get started, I would like to point out the customary disclaimer at the end of the podcast and just remind everyone to please seek professional advice from licensed professionals in any matter related to investment, tax, or other matters that might be discussed on this podcast. Although we have very qualified experts with us today, any topic we discussed should not be taken as advice. Perhaps we can have a brief introduction before digging into the topic. Sonya, you were with a large accounting firm before joining Raymond James, which is not an accounting firm. You want to tell us a little bit about your journey in cross-border and a little bit your role with Raymond James as well?
Yeah, absolutely. So I first got started in cross-border tax in 2016, doing a couple of internships at a Big Four accounting firm. And yeah, I always enjoyed cross-border tax. When I was going through my accounting bachelor's degree, I always knew that I liked tax. I thought it was really interesting to be able to help people solve problems. And I knew that tax was always going to be here and there's always going to be new challenges. And I always like learning. And even, 7-8 years into my career, I'm still learning something new every day. So I've worked in cross-border tax at large firms for about 6-7 years. And then recently joined Raymond James in late 2023 as the cross-border tax consulting manager. So I help advisors such as yourselves all over the country with their cross-border clients, and then also Canadian clients with any and all tax matters that come up, including estate planning, departure planning, and planning in terms of, even immigration out of the U.S., giving up citizenship and green cards. So lots of interesting topics that we can go over.
And it's a great industry to be in, and it's growing. Right? A lot of people might be surprised exactly how many Canadians are moving to the United States, Americans to Canada, or even Canadians that have worked there for whatever reason and then they decide to come back. Right? So it's a great field to be in. I very much enjoy it, and I know that Sonya is a great asset to have at Raymond James. Very tremendous resource, and always there whenever we need support. What should Canadians do or look into before they actually move to the United States? Obviously, from a tax perspective, obviously.
Yeah. So I think that the number one piece of advice I would give is to be prepared well ahead of time. If you're only seeking tax advice after you've already moved to the U.S., then, you may have missed out on some planning opportunities and perhaps are set up in a structure or have assets that are not ideal from a U.S. tax perspective. This should have been avoided. So I'd say the number one thing is to, take an inventory of all of your assets, all of your investments, and reach out to an advisor, cross-border tax accountant ahead of time to get that proper tax advice. Now we can go into a bit of what are the main things to look out for from a tax perspective when you're going to be moving from Canada to the US. So the main one that has a lot of people caught off guard is something called departure tax. So when someone ceases Canadian tax residency, they're deemed to have disposed of certain assets of theirs at fair market value. So people think, oh, does that mean I actually have to sell the asset? Well, no, it doesn't mean you actually are, forced by the Canadian government to sell your assets. But it's for tax purposes, you report your non-registered assets as if you sold them at fair market value. So if you have a significant amount of investments that have grown in value, you essentially have to report a capital gain on the tax return in the year that you cease Canadian tax residency. And now, as we're aware, with these new capital gains rules following the recent federal budget that are now into effect June 25th, 2024 onwards, any capital gains in excess of $250,000 per individual now have a 2/3 inclusion rate rather than 50%. So when we're talking about being proactive and planning ahead of time, if someone knows that they're going to have a very significant amount of capital gains on non-registered assets, and they know that they're moving to the U.S. in maybe a year or two, they have some planning opportunities to perhaps recognize some gains over a number of years before they move. So perhaps they could stay within that $250,000 threshold. And then on the flip side, more things to talk about, but on the flip side, on the U.S. side, if you're moving to the U.S. and you had assets that are subject to deemed disposition in Canada, you're able to essentially elect under the Canada-U.S. Tax Treaty Article 13 to get a bump up in your cost basis for U.S. tax purposes. So you're not going to be double taxed when you do eventually actually sell that asset in the U.S. as a U.S. resident. And I'll just talk about the fact that certain assets are exempt from this deemed disposition, and that includes registered accounts like RRSPs, RIF, TFSA, FHSA, and also Canadian real estate. And then also if someone was only a resident of Canada for a short term, less than 60 months, and they already held that asset before they originally became a Canadian resident, then that asset may also be exempt from this deemed disposition.
You touched on TFSAs there briefly. One of the common questions we get is in regards to TFSAs, tax-free savings accounts, and our ESPs, registered educational savings plans. And there seems to be some conflicting advice or opinions from the accounting tax community on these two. If I'm a Canadian moving to the United States, or even an American in Canada, what are some of the implications or things to consider about holding a tax-free savings account?
So with the tax-free savings account, from a Canadian tax perspective, if you're a Canadian resident, you can make contributions. It's all, tax-free up to the contribution limits, of course. But the IRS actually does not consider, it doesn't acknowledge the tax-free status of the TFSA. So from the IRS's perspective, it's just like a regular investment account. So if you're gonna be a U.S. person, which is U.S. resident, or a U.S. citizen or green card holder, any income within that TFSA is reportable on the U.S. tax return. But I think the big thing that could potentially have very large implications is, and this is where there's some conflicting advice out there, maybe not entirely straightforward, is that the TFSA may be seen as a foreign trust in the eyes of the IRS. And when a U.S. person has interest in a foreign trust, they have to file these annual forms 3520 and 3520A. And essentially, these forms could be they're quite complex. And if you're going to be paying an accountant to prepare these forms, it could cost a pretty penny potentially in annual fees. And then also if, perhaps you're late filing the forms, there could be an automatic $10,000 penalty, if not more. So for that reason, but the thing is, some accountants do and do not consider the TFSA a foreign trust. So that's something that is perhaps a bit more gray area. So definitely consult with the cross-border tax accountant to get their advice on what you should do with the TFSA. But important to note is when someone ceases Canadian tax residency, they cannot make any more contributions to the TFSA. Otherwise, the CRA may have a significant penalty on those non-resident contributions.
Exactly. And if somebody's moving to California, then there's even more regulations around it, correct? We're not going to get into that. That's probably a completely different conversation. But one opinion I've heard recently about the TFSA is if it's at a certain dollar value, then yes, you have to pay tax in the United States, basically. But because we use Ontario as an example, typically Ontario residents are in a higher tax bracket that the credits offset. So you still have the tax-free compounding in Ontario, and you don't really end up paying taxes in the United States. Whether that's the case or not, we'll leave it to the tax experts. The accountants actually prepare tax returns. But just something interesting that I've been hearing more and more about recently.
Yeah, I would say that, for perhaps U.S. citizens, U.S. green card holders living in Canada, I wouldn't discount the TFSA altogether just because the income is reportable on the U.S. tax return. As you mentioned, if they generate enough other passive Canadian income in a non-registered account that generates tax, you may generate enough foreign tax credits where you don't actually end up paying tax in the U.S. or you pay very little tax in the U.S. on that TFSA income. So just because it's reportable in the U.S. doesn't mean that it isn't potentially a great tool for U.S. persons. So it really depends on a case-by-case basis.
Okay, great points. Great. Could you talk a little bit about PFICs? Exactly what does a PFIC stand for?
Yes, so PFIC stands for Passive Foreign Investment Corporation. Essentially, there are these rules in place from a U.S. perspective, so from the IRS perspective, essentially deterring U.S. persons from investing in a foreign corporation that earns passive income and perhaps deferring the recognition of income and tax. So a lot of people think, passive foreign investment corporation, I don't own any corporations, I don't have to worry about that. But what actually gets caught under these PFIC rules is non-U.S. mutual funds and non-U.S. ETFs, so exchange-traded funds, which are very common investments for, everyday people living in Canada or even who are moving out of Canada. So the issue with holding PFICs is if you have these mutual funds or ETFs under the PFIC regime, you could effectively be paying tax at the top marginal rate in the U.S. on undistributed income from the PFIC, rather than income as it's actually earned, and perhaps getting more beneficial tax rates under, the capital gains treatment or qualified dividends. And on top of having potential really high taxes, there are these additional forms that have to be filed if a U.S. person has PFICs called 8621. And similar to the 3520s, very complex form, and it could be very costly for an accountant to prepare. And it has to be filed, and this form has to be filed for every single PFIC you have. So if you, for example, have a portfolio of, 10 different Canadian ETFs, that's 10 different 8621 forms, which could each cost thousands.
That could build up.
Generally speaking, when we're talking to clients who are planning on moving to the U.S., we take a look at their portfolio, identify what could be a PFIC, and perhaps rebalance that portfolio. So when they're U.S. persons, they don't have any of those PFIC concerns, and they could instead perhaps invest in just individual securities or U.S. mutual funds or ETFs.
And that's where one area that we actually bring a lot of value to is our expertise in understanding and identifying PFICs. And as a cross-border advisor being registered in Canada and a registered investment advisor in the United States, we are able to offer a complete solution to our clients. Right? So I think it's a tremendous value that we bring to the table.
Yeah, absolutely. I've definitely heard of some stories of U.S. citizens who have, different financial advisors who aren't familiar with any of these U.S. issues. And then, they have the nightmare of having a portfolio of 20 different Canadian ETFs just because the advisor wasn't aware of the U.S. tax issues. And then they have potentially hefty accounting bills, penalties, and a bad tax outcome effectively.
Or that's all the advisor could offer as well, right? Depending on registration in Canada, which compared to the United States, it's a lot different In the US, you're able to offer stocks, bonds, do options, mutual funds. In Canada, we have different registrations for mutual funds, and then there's the EMD market, and then there's the securities market for advisors. There's traditionally we're called brokers. Now today, they're advisors, which could offer stocks and ETFs, etc. But fantastic. Can we move over to legal business structures for Canadians doing business in the United States or looking to move there, but maybe not completely losing all ties to Canada? One that and I've gone through this myself, so I have exposure to the United States. We have businesses down there. We own investment properties. And if you speak to any lawyer in the United States, they're going to recommend LLC, right? Mm-hmm. As a Canadian, should we be opening LLCs?
That's a great question. So if you're in Canada, so the issue really is that Canada and US have different tax treatment for LLCs. And as a result of the different tax treatment, there is a potential for double taxation. So if you're a Canadian resident and you open a US LLC and you're, US person, like a US citizen, a single member LLC generally in the US is considered a flow-through entity or a disregarded entity. And what that means is any income in that LLC is essentially taxed on your individual US tax return. So it's as if, perhaps you're a sole proprietor and just earning that income outright. But the LLC from a Canadian tax perspective is seen as a corporation. And with a corporation, you are taxed when you make distributions from that, from a corporation as dividends. So there could be a bit of a mismatch where in the US, you're taxed on income as you get it, but then in Canada, you could be taxed on that same income in a future year when you take a distribution, and you wouldn't be able to get the foreign tax credits if that income is essentially received in different tax years. So yeah, definitely may not be a good idea for a Canadian resident to have a US LLC in some cases.
So in essence, we're potentially looking at double taxation. Exactly. Okay. Any other structure, or what's the most common structure that a Canadian would look at or consider if doing business in the...
Yeah, with doing business in the United States, definitely a good idea to talk to a cross-border tax accountant to get that proper advice. I know that there could potentially be issues if you're a US person and you're living in Canada and you have a Canadian corporation. There may be CFC or controlled foreign corporation rules that may trip you up. But a lot of the time, if you want to, keep things simple, you could consider doing, operating under a sole proprietor or under a Canadian corporation.
Okay, it's fantastic. And before we end off, if you have a couple more minutes, are the biggest trends, reasons Canadians are moving to the United States? What do you see come across your desk?
Yeah.
Or frequently these days?
Well, as we know, U.S. has very large market, lots of potential job opportunities. Getting paid in U.S. dollars is automatically 37% raise these days. So you see a lot of individuals who are moving to the U.S. for job prospects, perhaps younger individuals earlier on in their career, moving on to the U.S. For our opportunities. In Canada, there may be, I'm not an immigration expert, but there's different types of visas that may make it, not as difficult to work in the U.S. compared to individuals from other countries wanting to work in the U.S. And so with the perhaps more ease of immigration, also, of course, lower cost of living, a lot of folks coming from Vancouver or Toronto, a very, very high cost of living, very high tax rates. You have, tax rates at the top marginal rate over 50%. So never a good thing. And in the U.S., especially if you can move to a state that perhaps has very low state tax or even no state tax, such as Washington or Florida, then you could, not only be getting a higher income, lower cost of living, you also are paying a lot less tax. So that is definitely a trend we're seeing. And that, as you kind of alluded to earlier in the podcast, I definitely see a big trend of Canadians who have moved to the U.S., worked their professional years in the U.S., and then moved back to Canada at retirement. So definitely seeing that a lot. I suspect a lot of that has to do with healthcare costs. Of course, in Canada, healthcare, I won't say it's free, but it's, subsidized by the government. Whereas in the U.S., it's actually very costly medical insurance costs.
Yeah, there's nothing free. We end up paying for it, or somebody ends up pays for it.
Relative.
Yeah, exactly. By far, I think the most common client we take on are Canadians returning to Canada. In the example you just recently stated, where they work there, and they go there with the intent of going temporarily in a lot of cases, right? Like a contract job or relocated for a year or two, and actually end up spending 20 years or more, their entire career. And then it's coming back for the grandkids, the healthcare, everything else in Canada, right? So that's probably one of the most common type of clients that we take on is Canadians returning to Canada. And a lot of other clients are inheriting American assets. So Canadians with family members in the United States, and their family member left them as a beneficiary on their IRA, and they are completely lost as to what to do with it. And we deal with that on a daily basis, so we know exactly how to open up the right type of account, the tax implications, the 10-year rule, all sorts of things that come into managing those accounts. Sonya, it's been an absolute pleasure. Thank you so much.
Thank you so much for having me. Good to be here.